Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. In today's video, we are going to be talking about the most popular moving average used in Forex trading. Moving averages are essential for identifying trades and smoothing out price fluctuation, making them invaluable for both new and experienced traders. By understanding this moving average, you can enhance your trading strategy and improve your market analysis. Stay tuned until the end of this video as we discover each type in details and provide insight on how to effectively incorporate them into your trading routine. Now, the first moving average we are going to go over is called the simple moving average, the SMA. This SMA is one of the most widely used indicators in forex trading. It calculates the most it calculates the average price of a currency pair over a specific period in time. The average is updated as price data comes in, which helps you see the overall trend without being influenced by a short-term fluctuation. Now, to calculate the SMA, you simply add of the close price for a set of numbers of period and then divide them by the number. For example, if you are looking at the 10 period moving average, which is this blue line you are seeing on my screen, you would add the close price of the last 10 days and then divide it by 10. Now, this is an example of the 10 moving average. When the short term moving average, we're talking about the simple moving average in this example. When the short term moving average crosses above the long term moving average, it signals a potential buying opportunity. This is the short term. The blue line crosses above the long term. The long term, this is the 50 moving average. When the short term crosses above the moving average, it signals buying opportunity. Conversely, when it crosses below the long term moving average, it signals selling opportunity. The crossover strategy helps you make more informed decisions based on trend changes. Now let's look at the exponential moving average. Now, the exponential moving average is another popular tool in the forex trading department. Unlike the simple moving average, the EMA or the exponential moving average gives more weight to recent price. This means it reacts more quickly to price fluctuation, making it a valuable tool for traders which want to capture short-term trends. To calculate the EMA, you start with the SMA, that's the simple moving average for initial period. After that, you apply a multiplier to give more importance to the most recent price. The formula may yet seem complex at first, but many trading platforms such as the EMA calculator automatically calculates this for you. Now, this is an example of an EMA. This is the 12 EMA, 12 period EMA, the short term moving average, and the long term moving average, which is the 26 period EMA. For examples, many traders like to compare or likes to compound Many traders like to combine the short-term moving average, which is the 12 period moving average, and the long-term moving average, which is the 26 moving average. Now, when the short-term moving average or when the short-term EMA crosses above the long-term moving average, this signals buying opportunity, as seen here. When the short-term moving average crosses over the long-term moving average, it signals buying opportunity. Conversely, when the short-term moving average crosses below the long-term moving average, this signals selling opportunity. As seen, the crossover strategy helps you align or stay in line with the market trends and make informed trading decisions. So now the next moving average we are going to be looking at is called the weighted moving average, the WMA. The WMA. Now this WMA is another important tool in forex trading. Like the exponential moving average, the WMA gives more importance to recent price data. However, the WMA assigns weights in the linear manner, meaning that the most recent price has the highest weight and the weight decreases for older price. To calculate the WMA, you multiply each price by a predetermined weight based on its position in the series. Then you sum these weight prices and divide them by the total of the weights. This method allows you to emphasize on recent price movement while still considering historical data. Now this chart we can see has the WMA, the 10 period WMA, that's the 10 period weighted moving average. You can see how the WMA reacts to price changes on the chart. The line follows closely behind the price action, similar to the EMA but with a slight different approach. This responsiveness helps you to identify trend effectively while still smoothing out some of the noises in price movement. You can incorporate the WMA into various trading strategies as well. A common approach is to use it in conjunction with a simple moving average for confirmation signals. For instance, you can compare the short-term WMA with a long-term SMA. That's turning on the long-term SMA, this red line, that's the 50 moving average, simple moving average. When we combine this with a long-term simple moving average, it becomes easier to use. In example, when the short-term WMA crosses above the long-term SMA, it signals buying opportunity. Why? If it crosses below, let's not forget, when the WMA crosses below the simple moving average, the long-term simple moving average, it signals time for selling opportunity. This strategy helps you align your trade with the prevailing market trend. Okay, the next moving average we are going to talk about is the volume weighted moving average, the VWMA, the volume weighted moving average, which is a unique tool in the forex trading that both takes price and volume into account. Unlike other moving average that focuses solely on price, the VWMA gives more weight to the price that occur with higher trading volume. This means that it reflects the true market activity more accurately, provided that you have a clear picture of price trend. To calculate the VWMA, you multiply each price by its corresponding volume for a set period. Then you sum these values and divide them by the total volume for that same period. This calculation allows the VWMA to highlight price movements that are supported by substantial trading activity. Now I will turn on the VMA, and this is how it is on the chart. You can use the VWMA in various trading strategies, and a commonly well-known way of using this is to look for crossover between the VWMA and other moving averages such as the simple moving average. Turning on the long-term simple moving average, that's the 50 simple moving average. The strategy helps you to align. You can look at this strategy to confirm potential buying and selling signal. So how do we know that? Is when the VWMA moving average crosses above the long-term simple moving average. This signals buying opportunity. Conversely, when the short-term VWMA crosses below the long-term simple moving average, this signals selling opportunities. This strategy helps you align your trade with trend that has or that have a solid backing from the market participants. Now the next moving average we are going to look at is called the Hall Moving Average, HMA. Is relatively a newer tool in forex trading that aims to protect or aims to provide a smoother and more corresponding moving average, the HMA. It was developed by Alan Hall. The HMA combines with the weighted moving average with the concept of reducing lag, making it particularly useful for traders who want to capture trends quickly. The calculation of the HMA involves several steps. First, you calculate the weighted moving average for a shorter period and then another for the longer period. After that, you take the difference between these two averages and apply a square root to smoothen out the result. This method allows the HMA to respond rapidly to price movement while minimizing lag. Now the chart we can see on the screen is an example of a 14-period HMA. In this chart you can see how the HMA follows the price action closely. Its smoothing curves helps you identify trend without the noise that can come from other moving averages. This responsiveness makes it easier for you to spot potential entry and exit points in the market. You can incorporate the HMA with various trading strategies as well. A popular method is to look for the crossover between the HMA and other moving averages such as the simple moving average. This can help you to confirm your potential buy or sell signal. In this example, when the HMA crosses above the longer term SMA, the longer term simple moving average, it may indicate buying opportunities. As you can see here, the moment the HMA crosses above the long term simple moving average, price begins to go up. Conversely, if it crosses below the long term simple moving average, it may indicate selling opportunities. This strategy helps you align your trade with trends that are both smooth and responsive. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, share and subscribe. Turn on your notification bell so that you would never miss out on more trading tips and strategies. Thank you for watching and I will see you in the next video.